Hello, welcome to The Open right here on BNN Bloomberg. Let's get to the big stories we're bringing you from our newsroom. Canada's inflation rate slowed slightly to 2.3% year over year in January, as last year's temporary federal sales tax break continued to push up annual price growth. On the upside, gas prices slowed between December and January. Shelter price inflation dropped below 2% for the first time in nearly 5 years. And cellular services prices also fell on a month-over-month basis. Grocery prices rose at a slower pace compared with the annual rate in December. And the pace of home building in Canada continues to slow with no near-term signs of a turnaround. That's according to a report by the Canada Mortgage and Housing Corporation. The National Housing Agency says the seasonally adjusted annual pace of housing starts declined 15% in January. Housing starts can vary considerably month to month as big projects get started. But the agency's 6-month moving average for annual starts also showed a decline, this time 3.5%. AI Minister Evan Solomon is visiting Saudi Arabia and India after a trip to Germany as part of an effort to drum up new investment in Canadian tech. Solomon was at the Munich Security Conference over the weekend, and he'll stop in Saudi Arabia before going to the AI Impact Summit in India. Those conferences are happening as Prime Minister Mark Carney draws global attention for a speech in which he called for middle powers to work together against economic coercion. Looks like we are going to get a softer open for U.S. stocks today. The tech stocks in particular selling. Still, the Nasdaq set for a decline of less than 1% at the open at this rate. Let's have a look at how the TSX traded yesterday. Our market, of course, substantially up over the past 12 months, boosted notably by gold stocks, gold stocks and gold prices, which have been flirting around the $5,000 US ounce level. Not sure if we have that TSX right now. Maybe we'll move on to oil. And there we go. There is our benchmark index, and it's up, as you can see, more than 30% in the past 12 months if you include dividends. And it's up even without those, all about 29%. Let's check out oil, see how it's trading. A weak US dollar has provided support for crude. You can see it's losing a bit of altitude today. And let's see where gold is. Gold, according to one headline today in the Journal, gold positioning US dollar positioning, I beg your pardon, at its weakest, the most negative sentiment on the US dollar in well over a year. And let's have a look at the Canadian dollar, and it is down slightly today. And finally, Bitcoin, the biggest cryptocurrency. No joy there for the crypto bulls, still stuck below $70,000 US. The headline inflation rate slowed slightly to 2.3% year over year last month. But some of that is distorted by base year effects related to gas prices. Let's get perspective from Sadiq Adasha, Chief Investment Officer at BMO Asset Management. Sadiq, always great to hear from you. Thanks very much for joining us.
Thanks for having me.
Anything jump out for you with these inflation numbers?
No, I think this is exactly what we're expecting, that inflation is going to be relatively tame, both Canada and in the United States. The impact of tariffs that we've seen definitely has had an impact, but not as bad as people were initially expecting. And so I think you're seeing a broad-based decline in inflation, or at least steadiness in inflation across all of the areas that you had mentioned earlier. And that's a good sign for consumers that the cost of goods is not going to be, soaring through the roof, particularly as a lot of consumers have a lot of debt, and we're seeing interest rates probably not likely coming down in Canada as well. So definitely a good sign on the inflation front.
Last week, Citi said, we continue to see signs that the Bank of Canada is stepping slowly towards cutting rates again. Can you remind us what your take is, or what your expectation is for the Bank of Canada and rates this year?
Yeah, I think at this time, we're thinking the Bank of Canada is not going to cut rates. The reason really is that, for one, they're at the lower end of their targets. So there has to be a really high bar for them to cut rates. Given that we're seeing, inflation tame, we're not really necessarily seeing a lot of job losses per se. Bank of Canada is going to be in this difficult position of, to cut rates, really means that you're feeling either the economy is suffering quite a bit or inflation is exceptionally under control. And at the moment, it's hard to say that both are exactly true. I think that the USMCA deal will be the one that could cause the Bank of Canada to cut rates. If those negotiations are not going well, and there's a possibility that could occur, that could put pressure on Canada's economy, on growth, and that could fuel, potentially some job losses, and that would then cause the Bank of Canada to decide to cut rates and spur the economy again. But at this time, at least for the next few quarters, I don't see Bank of Canada cutting interest rates.
Maybe we can put up a 5-year chart for the Canadian dollar. You're not seeing a huge move for our currency at this stage. I mean, obviously, surprise cuts would tend to push down the loonie.
Yeah, I think if you look at both, the Canadian dollar versus the U.S. dollar, and the U.S. dollar versus the world currencies, the U.S. dollar has depreciated over the last, call it, year and a bit now. And that really has been the fact that we are seeing flows move out of the U.S. into other countries. We're seeing the U.S. still probably looking at rate cuts and Canada not looking at it. So the interest rate differential is starting to cause an appreciation in the Canadian dollar. However, I do feel that we've seen a lot of movement already on the U.S. dollar on the weaker side, that probably for the next few months, again, we're probably going to see the U.S. dollar hold its ground against the Canadian dollar, particularly as we go into this USMCA negotiations, because any pressure on Canada there would likely cause the U.S. dollar to strengthen and the Canadian dollar to weaken. So there's a lot to still watch out for in the coming months on both the interest rates front and also on the currency front.
What about gold? Of course, a big question now. Maybe we can put up a 1-year chart for gold. It's off its highs. Would you maintain? I mean, do you generally think portfolios should always have a bit of gold?
Yeah, so I would say that at this time, we are very bullish on gold still. I mean, we've been bullish since 2023. We've held it for multiple reasons, so it's not been the same reason in 23, 24, 25, and even into 2026. But I do think one of the key reasons to own gold is still geopolitical risks. And if January is any indication of what we expect throughout the year, this is what you want to own gold for. Despite the pullback we saw in January, it still outperformed this year, and we expect it to continue to outperform. Central banks are still buying more gold. We're seeing people hedge that against the U.S. dollar, obviously the geopolitical risks. And then just generally, you're seeing a lot more investments utilizing gold in their portfolios. And that's also adding to the demand part of the gold curve as well. So overall, I think this is one of the things that you do want to have in your portfolio, not just from the upside perspective, but just also from the hedging perspective against risks that could occur throughout the year.
Remind us what your stance is on tech, on AI. You don't think we're in a bubble, but what kind of stocks are you seeking out at this stage?
Yeah, as a portfolio manager, BMO Global Asset Management has to be careful on AI, right? Because we believe that AI is still something that is going to transform things, that is going to be very productive, that the AI companies, and it is selective, can still outperform. There's a lot of CapEx spending still going on. But that being said, the risk out there is not necessarily there's a bubble, but people think there's a bubble. And what that means is that we're going to likely see a lot of volatility, a lot of question marks on earnings, some uncertainty on what the savings are going to be on productivity and others. And therefore, that likely means that we're going to see a lot of volatility names, and people trim out of those positions with higher valuations to lower valuations, which means you have to risk manage your AI holdings and diversify across sectors as well, despite the fact that we still believe in the AI story. And that's just prudent risk management. And I think that's what you're seeing across a lot of the investors today. A little bit of rotation out of the big winners over the last few years into some of the older school economy names, things like Walmart, things that are like, gold, and things that have worked over the longer term, and not CapEx heavy like we're seeing in AI.
Just very quickly, do you see any hope in these traditional software stocks? I mean, without commenting on individual names, the likes of Adobe, ADBE, or Constellation Software, have they, generally speaking, been oversold?
Yeah, I do believe they have been oversold. I mean, the valuations were there and they were expensive. So I think you're seeing a bit of that rotation, as mentioned to you earlier. You're seeing movement into some of the hardware stuff. Memory, for instance, has done quite well. So there's a bit of rotation even within the tech space that I think you're going to continue to see play out. But I think there are going to be a lot of opportunities coming out of some of these pullbacks. And some of them have massive drops that are not tied to long-term fundamentals. And so, when you remember these pullbacks, always remember there's always opportunities in these spaces as well. And if you're a long-term investor, you want to start to dabble in these names, not jump all in at one point in time, but slowly take these opportunities to buy in the depths. And I think, again, longer term, there's still a lot of momentum in some of these areas. But sometimes you got to let people come out of those names, let the valuations kind of settle a little bit before you can see that long-term movement in those asset classes.
Sadiq, thank you very much. Now, Sadiq has very kindly agreed to stick with us for a second block. Sadiq Adasha, Chief Investment Officer at BMO Asset Management, will drill more into his investment strategy after this. Sadiq Adasha very kindly sticking with us for a second block. He is Chief Investment Officer at BMO Asset Management. Sadiq, can we take a closer look at the huge CapEx spend, hundreds of billions of dollars on AI build out in the States, data centers primarily? Is there a risk that it's overdone and that the indebted companies, for example, OpenAI, Oracle, are vulnerable?
Yeah, it's a great point. It's one that I think this is what investors are really debating. Is the CapEx spend overdone? And particularly now that it's not coming just out of your balance sheet, it's actually being funded by debt. And that makes the bar a little higher on the return potential coming through. Oracle was one of the early ones that you got caught up in that initially. And now you're seeing a lot of the other companies starting to dabble into the debt position as well, too. So I think that's an important thing to watch out for. That being said, I wouldn't really be betting against, Meta, Google, Amazon, and others in this space. These are companies that have, traditionally transformed. They're at the leading edge of technology. If all these CEOs together are, investing tremendously in AI, they're seeing the benefits out there. And I think this is an important thing to understand, that these are not things that are going to necessarily change things overnight. But we are already seeing some transformation today. And as we look out over the next few years, we'll continue to see massive transformation on productivity, on the needs for new hires to get into spaces that they couldn't get into previously, improvements in margin. I think all these things will happen over time. The question is, will the amount that we're spending today justify all of that, and how quickly is that payoff going to be? And I think this is where investors have not been patient enough, and I think they're trying to get to that answer quicker, and that's causing a lot of the disturbance you're seeing in the AI names because they're worried about the CapEx spending. But I think the CapEx spending will only continue to increase this year, highlighting the need to continue to invest in these data centers and the technology that's needed to continue to win in the space.
I just wonder, though, if OpenAI, say, runs into serious trouble, has to cut back on spending, could there be a cascading effect if they stop buying so many NVIDIA chips, for example?
Yeah, there is the connection between all these companies, right? As you said, the spending means buying another company's chips, for instance, and then they have investments back in the original company. So there is some of that for sure that has to be watched carefully along the way. Suppliers are demand people, demand or supply people. So it kind of works together in that standpoint. So that is definitely a risk in this process for sure. But I think, as you look through, there's always someone stepping up to take someone's place. Obviously, U.S. was at the forefront of the AI space. You're seeing China step up quickly. I think they just launched another, generative AI app as well. So there's lots of, other areas to step in to take on that demand going forward. There is also supply constraints at the moment in some of these areas. So chips that people want can't get to because there's not enough supply for that. So that is still in the process of all this happening. And of course, and then data centers, there's hydro and energy that are all important parts of that build out as well, including land. So there's lots of things, variables that are involved in this, and there is definitely a risk in some of those areas. But I think it's still too early to say that risk is much higher than the actual benefits you're going to get, out of the AI situation.
The TSX hitting a record high not long ago. Let me just check. That was Tuesday of last week, I believe. You think Canadian stocks, and I know it's hard to generalize, look like better value than American equities?
I do. I think from a valuation perspective, Canada looks much better than the U.S. and others from a valuation perspective and from a risk perspective as well. So if you're expecting global markets to be volatile and sell off, then Canada probably will hold up well, particularly because it has the precious metals that tend to do well in that environment. So the commodity side will hold up well. But that being said, if I look at underlying fundamentals, I don't think Canada matches up with the U.S. or emerging markets on that front. I think both those markets should have better returns going forward. Again, for Canada to do well, it needs gold financials to really hold up well, and energy as well. And that's a tough feat given what they did last year. Whereas on the U.S. front, I think it's a more broader sector diversification story. And then in emerging markets, you've got a lot of areas doing well. I think, India just came back from, looks positive and strong. China's starting to turn the corner, in our opinion. And you've got obviously Taiwan, Korea, Brazil, all doing well. The former two, more tied to the AI story as well. So I think there's lots of opportunities geographically. Canada's not where we would first put our money in. But again, if you're worried about risk and defense, then Canada might be your best choice from that perspective.
And sorry, you said emerging markets looking more attractive than Canada, for example?
Yeah, absolutely. I think, emerging markets have done well. Look, I'll pick on India for a second because I was just there. You saw them make a big deal with EU and then with the US that creates a great trading platform for them, lowers the tariff front. They're trading more with EU and EU's buying more from India. So a great partnership there. Both India and China have massive population. The middle class continues to improve. Yes, China has a bit of the property sector problem that's going on, but looks like there's some things starting to work out there as well. They're strong, again, on the AI front. And so you're seeing a lot of, adaptations and changes going on within these areas. And I think it would be hard not to be investing in countries that are future growth potentials with a massive population and a middle class that's growing. And I think that's an opportunity that people have been underinvested in over the last few years. And I think this is the year again, coming off last year's strong environment, that we could see, and again, another strong year by emerging markets.
Sadiq, thank you very much indeed. Sadiq Adash, Chief Investment Officer at BMO Asset Management. After the break, the federal government today is set to unveil its long-awaited industrial defense strategy. It's a sweeping Buy Canadian plan backed by an investment of about $6.5 billion. And it's designed to shift as much as 70% of military procurement to Canadian firms. That's ahead. Canada can't rely on others for its security. That's the message from Ottawa as the federal government rolls out a sweeping new defense industrial strategy, betting big on homegrown production. Here's CTV's Paul Hollingsworth on the potential stakes, reporting from Halifax.
The $6.6 billion defense strategy is reportedly designed to support Canadian businesses and position Canada to shift away from relying too much on the U.S. while still meeting its NATO commitments. The government also plans to add 125,000 defense jobs over the next 10 years.
These are eye-watering numbers in terms of investment into defense. And yet there's still a distinct lack of detail, although we're supposed to get more of that tomorrow.
Prime Minister Mark Carney was supposed to announce these changes last week, but it was delayed after the mass shooting in Tumbler Ridge. Former Defense Minister Peter MacKay has lingering questions as he awaits more details.
Where does the money come from? Does the money come from cuts to other departments? Does it come from a drastic increase in revenues that will be generated by sales of Canadian goods, mainly energy? Or is this all going to be more borrowed money?
125,000 defense jobs could have a major impact on Halifax.
We are home to the largest Canadian Armed Forces base in the country. We're home to the headquarters of the 5th Division of the Canadian Army, 12-wing Shearwater Air Force Base, home to the East Coast Navy.
According to this military historian, other Canadian cities would also be positioned to benefit.
Obviously, Bombardier in Quebec, London, Ontario with General Dynamics Land Systems, but Halifax has Army, Navy, Air Force defense industries all connected.
A lot of defense jobs over the next decade could also lead to some pressures. If more people move here, it could add to the housing shortage already impacting this city. Paul Hollingsworth, CTV News, Halifax.
And let's check out U.S. equity futures as we count down to the opening bells. And it looks as though we are going to get a slightly soggy open for U.S. stocks. Where is the S&P 500? 6,830. Its record high close was back at the end of January, on January 27th. That's when it closed at 6,978, just shy of the 7,000 mark. General Mills is a stock to watch today. You can see those shares have sagged over the past year, bounced off the bottom though. It now sees a drop in its fiscal 2026 adjusted operating profit of 16 to 20%. Earlier, it saw a decline of 10 to 15%. It's citing weak consumer sentiment. And let's have a look at gold, see how that's faring right now. Gold down a little bit. China, though, the Chinese market closed for Lunar New Year. And we've heard about massive retail demand in China and India. Small investors in China in particular piling into bullion. And there's been near record imports into India, according to the data. Of course, a fair amount of smuggling goes on. Near record gold and silver imports through January. And let's have a look at Bitcoin. We got to leave it there. We'll have a look at Bitcoin later. Opening bells are next. And there it is, the opening bell action at the NASDAQ. It's 21 shares ringing the opening bell. At the NYSE, it's USA Today. And in Toronto, Mackenzie Investments is doing the honors. It's time for the first 15. Checking in on the equity markets as we begin the day. We did see some pressure, remember, on oil earlier after the Iranians indicated that talks with the states on their nuclear program appear to be at least continuing. Maybe not going great guns, but the Iranians expressing some optimism there. And oil has come under pressure. That's always tough on Toronto stocks. Oil down slightly, just north of 62.70 right now, US dollars a barrel. And there is a look at the S&P 500, and you can see more concerns about AI. Is there overspending, and how disruptive will it be hanging over the market? Let's check out some stocks of interest here. Enbridge was downgraded at Jefferies to hold from buy. The analyst Sam Burwell saying that these Canadian energy stocks, including the midstream players, have been on a tear for the past few weeks. The analyst argues that this may be due to weakness in U.S. techs sending money into the energy sector. But Burwell, the analyst, warning that midstream companies aren't likely to get a re-rating in the near future. In other words, investors are willing to pay higher multiples. So an analyst turning cooler on Enbridge there. And Sherritt, they mine nickel cobalt in Cuba. And as you might expect, the fuel squeeze on that island nation hurting their operations. Stocks sliding about 12% there. It's reducing operations at its joint venture in Moa, Cuba, due to fuel shortages. And the processing plant is going to be placed on standby within the next week. National Bank's analyst Shane Nagel says this will hurt profit to the tune of $300,000, or about 3% of the EBITDA estimate for every week of sales that are affected. And let's get some movers south of the border. We're joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Jeff, great to see you. Thanks very much. What's happening at Norwegian Cruise?
Yeah, Norwegian Cruise is the top performing stock in the S&P 500 this morning, up 6% in the pre-market session. Worth watching today, we have an activist investor that has been building up a big stake here and potentially going to shake things up. So Elliott Investment Management, there's a Wall Street Journal report out that they have supposedly built up a 10% stake in Norwegian Cruise Lines, and the result here is the stock is moving higher this morning. This is an operator that has been under pressure. It lost about 19% in 2025. It was down up until this morning. It was down on the year to start 2026, but a great big move higher might erase that year-to-date loss so far. Worth noting, within that Wall Street Journal report this morning, apparently Elliott has picked a former CEO of Royal Caribbean Cruise Lines to be part of this kind of board shakeup push that it is looking for at Norwegian. So a stock to watch this morning. We have seen a little bit of activist, some other announcements this morning as well. But Norwegian is the one with the biggest move, at least so far.
And what's happening at Danaher, the big supplier of medical equipment?
Yeah, Danaher is down this morning. They are going to spend $9.9 billion buying a company called Masimo. This is a medical device technology company. You may remember them. They have been under a lot of, they've been, I guess, engaged in a long-term fight with Apple over patent infringement, specifically for the ability to monitor some of your health in the Apple Watch segment. And in November, they were awarded a $634 million settlement from a California jury in their kind of patent fight with Apple. So, they got, it's been kind of a long-term thing here. Now Danaher is buying the company as well, with this kind of cloud removed from the long patent fight with Apple. And as I said, Danaher is one of the worst performing stocks in the S&P 500 so far this morning. Great big deal price and great big premium that they're paying for Masimo, 40% premium on the shares this morning. And so that's having an effect on Danaher's stock so far.
Thanks very much, Jeff. Bloomberg's Jeff Morgan. Coming up after the break, a slowdown in the Canadian headline inflation rate. We'll get more from Manulife's Dominique Lapointe. Let's drill into the inflation rate. It slowed slightly to 2.3% last month. The economists had thought it would hold steady at 2.4%. And it's interesting as well, because a year ago, the federal government had cut GST rates, and that brought down the price for booze and restaurants. Of course, that cut no longer in effect. So that has tended to push up prices, for example, for restaurants. Still, inflation coming in slightly lower than expectations. Let's get more from Dominique Lapointe, Director of Macro Strategy at Manulife Investment Management. Dominique, thank you very much indeed for joining us.
Good morning.
What do you think? Was there any surprise, anything jump out for you with these inflation numbers?
I think it's a very good report overall. If it wasn't for last year's tax break that you've just mentioned, I think we would be very close or at 2% on the headline CPI target. And what we see is it's been around 3 months that we really struggle to find inflationary pressure in Canada. And that's also consistent with what we see elsewhere in the economy. Wage growth isn't very strong, and companies are saying they're not intending to raise wages a lot this year. And at the same time, overall, there isn't a lot of economic growth, like we already know. Mm-hmm. So it's consistent that we see those kinds of weaker inflationary report, and that's probably a good news for policymakers in the Bank of Canada.
And I think you talked about companies and their propensity to increase prices. Do companies feel they can get away with it right now, generally speaking?
I mean, I think it's been documented that some of the past ability for companies to raise prices when input prices were up and they had the ability to do so is sustained. And so when their input prices are coming down, they're not really quick on lowering prices, mm-hmm. especially at the retail level. But at the moment, they don't have a lot of ability to pass on those input costs, and at the same time, they would report that their input costs are not growing as fast as they did. So I don't think that's the biggest issue at the moment.
Mm-hmm. You say that the central bank does, you touched on this, disinflationary forces right now. Tiff Macklem and his colleagues are seeing those, including slowing wage growth. Are we at any risk of moving towards deflation, Dominique, at this stage?
Yes, so deflation, outright deflation is still very, very far overall. Mm-hmm. So like we mentioned, inflation is still around 2.3%. Core measures, the one that would strip out the volatile items, depending on how you look, they could be a bit above 2%, but on the momentum basis, when we look at, let's say, the last 3 months, they're slightly below target, around 1.7%. But then again, you're very, very far from the deflation. Where we could see deflation, though, is in shelter, which is a surprise, and it hasn't been that for many, many years in Canada, where you have mortgage interest costs that are slowing because mortgage rates are lower than a year ago. You have home prices that are either slowing or falling, depending on which cities you're in. Mm-hmm. And rental prices also falling in Canada, which is a rare occasion. And that has impact on other adjacent categories like insurance, so slower inflation there, and even repair. So that's another good news for consumers.
That's interesting. Rental weakness. I'm not sure if you have a handle on this. Is that a national thing, or would it be very much driven by Toronto with our huge surplus of condos?
Depends on the market. It's again very heavily tilted by Toronto and Vancouver, because many units that were built for condo purposes are now either redirected towards the rental market because you didn't sold them. You're putting them on the rental market. Mm-hmm. But in other markets where rents are controlled, like Montreal, there is somewhat of a slowdown too. So it's both a national story, but also a city-by-city story. And again, there's still some very tight spot in the rental market. Rents are high compared to where incomes are, but the big story is that it's slowing.
Bank of Canada, you think it's highly unlikely they'd be inclined to increase rates this year?
Yes. And the reason why we do mention this to our clients is because after the December labor force survey, which showed very strong jobs growth, the markets started to incorporate the possibility that the Bank of Canada would hike one time, even more than once this year. We know that some of my colleagues are anticipating that there will be rate hikes. We're not of this view for three reasons. The first one is inflation, like this morning, doesn't seem to be a big concern. Economic growth isn't very strong, so it's hard to envision that strong growth now will lead to more inflation through wages. And at the same time, the biggest reason why it's hard to move at all from the Bank of Canada, both on the cuts and on the hike side, is the uncertainty with the current trade uncertainty and upcoming trade uncertainty with the USMCA renewal process.
So do you think Tiff Macklem will just be inclined to do nothing for now? Masterful inactivity?
That's what we think. That's what we've been thinking since October. Actually, the way that they view rates right now is that it's slightly below neutral, just a little bit. So that's providing a little bit of boost to the economy, and we sort of see it through some of the consumption measures they're holding on. We think that the housing market by the middle of this year will pick up a little bit. But that's not enough to think that we're going to get a big boost. But again, there's a lot of uncertainty about that. If we get a deal with the U.S., then maybe business investment picks up, and then there's a scope from some slight firming. But until we see that, it's hard for anyone to predict. We think that the Bank of Canada will be on hold, and they're going to signal that they're going to stay on hold.
Dominique, thank you very much indeed. Really appreciate it.
Thank you.
Dominique Lapointe, Director of Macro Strategy at Manulife Investment Management. We've got lots more coming up on the Open. Just a reminder, on Friday, we were joined by Nadeem Kassam, Chief Investment Strategist and Portfolio Manager at Marnoa Private Wealth Council. His top picks were Brookfield, WSP Global, and CP Kansas City. And today on the show, it's Rebecca Telcher, Portfolio Manager at New Haven Asset Management, and she'll take your questions on Canadian dividend stocks. Just ahead, BHP shares sitting at the highest level in nearly 15 years. The mining giant just saw profits surge 22% amid a historic metals rally. And the company just signed a massive, really massive streaming deal with Wheaton Precious Metals. We'll hear from the BHP CFO next. Just looking at BHP stock here, we just looked at the ADRs in US dollars, and looking at the Aussie dollar chart here, the shares now trading in Aussie dollars at their highest since at least 2006. And of course, the metals rally has had a big part, has played a big part in that. The company has been working for years now to shore up copper production. We got perspective from the CFO, Vandita Pant, who discussed the details with Bloomberg's Paul Allen.
Yeah, very pleased with the copper performance in the half, along with the rest of the portfolio, Paul. For the first time, 50%, more than just about 50% of our earnings, EBITDA, came from copper, and performance across our assets has been very good. To take example of Escondida, which is our largest mine that we run in Chile, we are revising the guidance up for this year and next year, which means that we will be producing more copper in the constructive copper price environment that we are in. So very pleased with that. And not only that, across our assets, as you would know, we have a lot of byproduct in our copper segment. In our assets, in the half, almost $2 billion of byproduct revenue was booked across gold, silver, and uranium. So a fantastic business and really reliable performance coming through across all our assets, with more to come in terms of the higher guidance for Escondida, for example, that I have given, along with the outlook on medium term with the copper projects. We have 4 very attractive copper programs around the world, in Chile, in Argentina, in Australia, and in the US, which means that we will increase our copper production from where we are into the future as well. Just last 4 years, copper has increased by 30% in production volume, and we are the largest copper producer in the world. So from here, we go into increase in copper to 2.5 million tons of copper equivalent, including byproducts, volume by mid-30s.
Now, you, of course, made a bid for Anglo American's copper assets last year, which wasn't successful. But do you see there being more just asset-specific M&A coming forward or blockbuster deals? What are you looking at doing in this space?
So look, we are very deliberate in the way we execute our strategy. And that is not predicated on inorganic or M&A growth. Of course, we are a big company, so if there are opportunities to bolster our organic portfolio, which is massive, with inorganic opportunities, we do so. But the bar for that is very high. It has to create shareholder value, has to be with discipline, and has to be good quality assets. Having said that, so we will look at it if there is an opportunity. But if I were to bring it back to our organic growth portfolio, Escondida, Vicuña in Argentina and South Australia, which goes from 300 KT of copper today to 500 KT plus in early 30s, and then further to 650 KT, for example. And Jansen, our growth projects, if we did nothing but executed on all our growth pipeline, it will be a fantastic result for our shareholders. But I should also say that we have done for value M&A. Vicuña that we got is, like we have mentioned, with details, a massive deposit which has grown even further since we entered into the joint venture for that. And now we have a growth program in Vicuña which goes up to overall, all 4 stages, to 800 KT of copper equivalent, including byproducts. And in Copper South Australia, Oz Minerals M&A, which was done, merged with the Olympic Dam in South Australia, this basin performing so well. And that was done when copper price in consensus was $3.50. So this was a very deliberate way in which that was done, and it is unlocking a lot of value. The byproducts in Copper South Australia are material. In fact, almost $1.7 billion of revenue in Copper South Australia in just first half was on account of byproducts, and we'll go from here on. So very comfortable with that.
Still on BHP, Wheaton Precious Metals has signed a record-breaking silver stream deal with that company. It's $4.3 billion US they're paying upfront to BHP to get dibs on silver from the huge Antamina mine in Peru. It's going to be about a third of the silver from that mine, as far as I can see. And then after Randy Smallwood of Wheaton gets his mitts on 100 million ounces of silver, BHP will then deliver the equivalent of about 22.5% of the silver over the remaining life of the mine. And it looks as though BHP or Wheaton will pay only 20% of the spot silver price. So let's get a little bit more on that massive bet on silver by Wheaton Precious Metals. Okay, we're going to have more on that from Bloomberg senior commodities reporter James Atwood right after the break. Let's get more on the metal market. We are joined by James Atwood, senior commodities reporter at Bloomberg. Thanks very much for joining us. James, could we kick off with this deal between Wheaton and BHP? It's massive, of course. It's Wheaton's biggest deal, biggest stream deal. They're paying more than $4 billion US to get their hands on silver from the Antamina mine in Peru.
Right, yeah, it's a massive deal, and it's a good way for a company like BHP, which considers silver to be a non-core metal, to raise some money for its core operations without undermining any of the other metals that come out of that same mine: copper, lead, and zinc.
This deal broke yesterday, actually, the Wheaton deal. The stock is down today, but hardly. I mean, this with a massive increase in silver prices, a big chunk now of Wheaton's revenue, pro forma revenue, and is now silver.
Yeah, for a lot of the mining industry, I mean, silver is a byproduct. There are very few pure silver operations. So it's not just BHP that will be looking at this kind of thing. I mean, companies like Southern Copper, for instance, produces a lot of silver, and you're right, at these prices that becomes very valuable, helps push down costs for mining companies as well. So it's a big impact on their bottom line.
Could we swing to Sherritt? They've long produced nickel, cobalt in Cuba. They're having trouble, as one might expect, with the fuel shortage in that country.
That's right. So it's crunch time for them. They're unable to receive the shipments of fuel that they need to keep running that mine. So they've reduced operations as far as we know. And if they don't obtain fuel from other sources, then they're going to have to halt altogether their mining and processing operations there in Cuba within a week.
And of course, they've been a long-time player in Cuba. The stock has not done that well over the years. Last time I looked, it was only 18 cents. But fascinating that the entire Cuban economy seems to be grinding to a halt.
That's right. I mean, this mine is halted, which looks to be the case. Then obviously that's a big deal for the company, for its bottom line. It's a pretty big deal for Cuba's economy as well. It's probably one of the biggest, if not the biggest, mineral operations there on the island. Not such a big deal for the cobalt and nickel markets globally, given it's a fairly small operation compared to the giant operations in say Indonesia.
Yes.
But for the company and the country, it's important.
Thank you very much, James. Really appreciate it. James Atwood, Bloomberg Senior Commodities Reporter. Up next, worries about AI disruption continue to weigh on the markets. We'll get perspective after this. Welcome to the second hour of The Open. Let's check out the big stories we're bringing you from our newsroom. The year-over-year inflation rate slowed slightly last month, even though the expiry of last year's temporary federal tax break did push up some prices. Data from StatsCan indicates that the annual rate of inflation ticked down to 2.3% in January versus December. Gasoline prices were weak, and prices for shelter price inflation dropped below 2% for the first time in nearly 5 years. Canada has signed a preliminary trade understanding with Mexico. The Minister of U.S. Trade, Dominique LeBlanc, says Canada and Mexico will work to expand port-to-port trade. We'll also hold talks on security. Ottawa sees investment opportunities in the pharmaceutical and agricultural sectors. A Canadian delegation is in Mexico till Friday. The pace of home building across the country continues to see a slowdown. Canadian Mortgage and Housing Corporation says the annual pace of housing starts declined 15% in January, with no near-term signs of a turnaround. The agency says it expects new construction to continue to trend lower, affected by trade and geopolitical uncertainty, high construction costs, weaker demand, and rising inventories. And there you have a look at the TSX, down slightly today. Gold prices have been weak, slightly weaker. Let me just check now. We have seen selling in some of the big gold names, and that has hurt our index. Gold slipping below $5,000 today. And let's have a look at the U.S. markets. Big traders south of the border in dollar terms today. As usual, Nvidia's up there, and it has dropped almost $2 today for a decline of 1%. Tesla's down about 2%. Micron's off, Alphabet's off, SanDisk. Apple holding its own. It's up about 1.4%. Those Mag 7 tech giants in the United States still under pressure, and smaller tech stocks too, amid fears AI will harm their business models. Our guest says this may lead to an actual correction for the U.S. market and open the door to buys at lower prices. We're joined by Mike Vanoker, portfolio manager and senior wealth advisor at IA Private Wealth. Mike, great to see you. Are you? Thanks for joining us. Are you keeping your powder dry, though? Are you tempted to buy some of these big tech stocks that are off their highs?
Yeah, thanks for having me, Andy. Good morning. Yes, we are definitely tempted, but we are tempering our enthusiasm for the time being. We think we've been anticipating some kind of a pull-off, some kind of a correction. I think the NASDAQ is off 5 or 6% from its highs. So, we still haven't had a nasty correction, if you will, call it 10%. We wouldn't be surprised if we had a very sharp, short correction based on, the fears that have been building up in the market with respect to the big tech giants, the spending, and all of the other news items that have been filtering in through the system.
Yeah, it's amazing. I hadn't realized this sell-off had been this tough. Microsoft, for example, is down about 18% this year. Amazon down about 15%.
Yes, and both of those are on our buy list, full disclosure, but we have not bought them yet. We anticipate that prices may go down even further. Our feeling is that market participants have been pricing these companies at very high multiple to earnings. And we believe that there's been a shift in mindset in that maybe as an investor, you don't want to pay that kind of big multiple because the growth is not going to be the same in the future as it was in the past. So we think that we're maybe seeing a growth slowdown, a shift in slowdown. And then the other thing is the constant amount of spending of free cash flow for these build-outs. How do you start valuing, as a value investor anyway, how do you look at these enterprise valuations and think about being a shareholder, and how do you need to adjust the fair market value of that equity given what we're seeing in the market?
So Amazon, a stock that's catching your eye at this stage, but you're not necessarily putting new money into it?
Absolutely. We don't own it at all right now. We would like to own it. We really think Amazon is a wonderful enterprise. Having said that, they are spending, you could say an obscene amount of money, or not spending, rather, I should say, investing. Fabulous operator. I mean, there's not much you can knock about Amazon. For us as value investors, it's not the business itself, it's the valuation of that business. And we want to proceed with a margin of safety. So we think that the tech sector, which has been the runaway leader, the runaway winner, for many years, but especially the last 3 years, is giving way to some other sectors because you have been seeing this rotation. And so you do want to buy some of these fantastic businesses, but we think you want to buy them with a much bigger margin of safety on the valuation of the equity to then be able to ride back up the growth in the business and perhaps the expansion that will occur to the valuation as the earnings once again expand into the next cycle.
You have an idea for us, Martin Rea, auto parts, part of their business. You see promise here, Mike?
Yeah, this has been sort of a dead money stock for quite a few years, even though we think they've been great operators. There was this bump during COVID in terms of car sales, because for a while they couldn't produce cars because of the shutdowns, and then there was this rush to purchase cars, and so a lot of the automakers and parts manufacturers had this big bump, and then we had this lull again, right? Martin Rea, we believe, has been executing really well. You have now a solid balance sheet. The debt to trailing EBITDA number has come in quite substantially to 1.5, which we think is a very healthy level. The company is a shrewd allocator of capital. They operate in 10 countries. They have a huge amount of facilities. They have major contracts with all the OEMs. You get a nice dividend while you wait. And they have been an acquirer of their stock. And now that their balance sheet is in such great strength, we think that they could accelerate the buybacks here.
And then you have another one for CRBG. Tell us about that stock. What do they do?
So Corebridge Financial is a typical life co. It's a mid-cap life co, competes with MetLife, Prudential, Lincoln National, which we also own. We like that space, especially at this point in the cycle, because we feel that well-managed life insurance companies are earning well above very good returns on equity, in other words, very cheap on a price to earnings basis. I think they trade at 6 times forward earnings. We think that given where they are in terms of their regulatory-based capital, which is very, very high, it will allow them to accelerate their share buybacks, allow them to accelerate perhaps their dividend increases. And more importantly, it's just a very steady Eddie run business. You get a 3% dividend. You're buying something at 6 times earnings. We think that earnings from here could go up by 20 to 30% over the next couple of years. So if they can get their earnings to, let's say, $6.50 by 2028, would you pay maybe 10, 11 times earnings for something like that? We think so. And so today, at a share price of $31, we see a tremendous amount of value. You get paid while you wait, and you have a pretty big margin of safety.
Mike, always great hearing from you, and thanks very much indeed.
My pleasure. Thank you for having me.
Mike Van Noker of IA Private Wealth. Coming up, we are going to zero in on this massive trend we've seen over the past few years. Investors moving away from mutual funds and into ETFs. Stick with us. Welcome back. This is a boost. Good news for electric vehicle buyers. Federal rebates are coming back for cars assembled in Canada or vehicles that come from countries with which Canada has a free trade agreement. CTV's John Venavali Rao was at the Canadian International Auto Show. He tells us why this relaunch of the rebates is refueling controversy.
At Canada's biggest auto show this year, a lot of the focus has been on electric vehicles.
I think personally, my next vehicle will be an electric.
With automakers plugging their latest models, hoping the return of the federal rebate will rev up a bit of a sputtering market.
Every little bit helps. I'm not going to complain, that's for sure.
After a year-long pause, anyone buying or leasing an EV as of today can get a $5,000 rebate or $2,500 if it's a plug-in hybrid. The program only applies to vehicles costing less than $50,000 unless they're made in Canada. Some think that's too low given how expensive EVs tend to be, though the number of vehicles in that price range has rapidly increased, with Transport Canada now listing more than 70 on a website.
Now, while Ottawa and Beijing recently reached a deal to lower the tariffs on nearly 50,000 made-in-China EVs, none of those will qualify for the subsidy.
Automakers are hoping the resumption of the rebate will put EV sales back on the road to growth. They fell from 15% of vehicle purchases in 2024 to about 9% last year.
So we're actually anticipating it to actually come back up now that the incentives are back, essentially.
Still, some potential buyers say they remain reluctant, concerned about the number of charging stations, particularly in rural areas. And some remain anxious about the range of EVs.
Just the range in the wintertime. They tend to be like 30% less.
But many told us, despite such concerns, they are open to buying one.
We'll see where it goes. But yeah, definitely looking into it.
A subsidy proponents hope will drive more demand. John Benavalli-Rao, CTV News, Toronto.
Now it's time for the ETF report. Our guest says just like cassettes were replaced by CDs, which of course are history now themselves, ETFs are slowly replacing mutual funds. Let's get more from Andres Rincon, head of ETF sales and strategy at TD Securities. Andres, thanks very much indeed for joining us.
Andy, thank you for having me.
Give us some perspective or stats on the extent to which ETFs have supplanted mutual funds.
Yeah, look, we've seen a great evolution over the last few years. And the way I call it, we're currently at the great migration stage of moving from the mutual fund structure to the ETF structure. And as you mentioned in the intro, currently we're in that same transition that the music industry had many years ago and over decades from the cassette to the CD. Mm-hmm. It took a long time, but we are slowly moving fully to the CD structure, and we're moving that, or we're doing that in the fund industry right now through ETFs. If you look at ETFs specifically, over the last few years, we've seen ETFs outsell mutual funds consistently now over the last couple of years. Just last year, we had $122 billion go into ETFs, and that's a new record. If you look at just January itself, we had about $22 billion in net inflows or $27 billion in gross inflows, which is a significant number, especially when you compare it to the U.S., which also had a very strong year, but not a 10 times multiple. Generally speaking, a 4.5 multiple versus the U.S. So Canada is doing really, really well. We're also seeing brand new ETFs come into the market here in Canada every single year to the tune of 1.4 ETFs every single trading day, which is an astonishing number.
Yeah, and it's interesting. Sorry, I was going to say the big growth has been in active ETFs, but you say that still only about a third of the ETF assets under management in Canada are active. The rest are essentially passive.
Yeah, and it's important to remember that Canada is a leader in active ETFs, but it's only a third of AUM. But if you look at just last year, 2/3 of ETFs that were launched were active ETFs. And now we're seeing flows also going to active funds. Last year was almost the first year where we saw more than 50% of inflows in Canada going to active strategies. And so this has been a big transition, similar to what we see in mutual funds, towards an active structure, an active strategy. And not just here in Canada. In the U.S., we also have a large move into the U.S. A third of flows in the U.S. have been in actively managed ETFs. And look, in the U.S., the actively managed portion of ETFs is very small. It's called 10% or so. But that number is growing quite rapidly. The other clear signal that we're moving into a more mutual fund-like industry in ETF land is how complex these products are getting. we're seeing complex derivatives, auto-callables, notes, private assets now in the ETF structure. Not just today, or sorry, last week, we had a new filing in the US that looked more like betting markets in the ETF structure. So we're getting a lot more in the ETF, and it's looking a lot more like the traditional mutual fund industry.
It is interesting you touch on this apparent blurring of the line between gambling and investing with the rise of these prediction markets, for example.
Yeah, and that's a very interesting development. We will see if the regulators in the U.S. and maybe in the future in Canada will look at these and it will give the okay or the green light on these, given that they're completely different. The assets that they will hold will be very different. They'll be very much a binary ETF. So we are all really looking forward to seeing what the regulators will say. And from a market making point of view, this will be quite interesting for us to look at.
You note that the industry, no lack of creativity. There's a critical minerals ETF, for example, XETM from iShares.
Yeah, the XETM or the iShares S&P TSX Energy Transition Materials Index ETF has been one of those ETFs that has garnered some attention. It's not just that one. In the U.S., we've seen about $5.6 billion go into critical minerals ETFs. Now we have not just Canada, but also the U.S. and many other countries look at critical minerals to be part of what we consider defense and part of the sovereignty of a lot of these countries. So we're seeing a lot of interest in these names. Great example is silver. We had a lot of assets going, a lot of trading going to silver over the last few weeks. Just a couple of weeks ago, we had $41 billion in trading in a single day, more than the broad market ETFs, just because these markets are moving so much and there's so much attention right now with silver and some of the other ETFs. We also have copper that's been quite popular. And overall, the trade has gone more towards Canada. We've seen a lot of interest in Canada, not just from a performance point of view, but we've seen a lot of interest in Canadian markets. We are trading more and more than we've seen in a long time, Canadian equity-focused ETFs. And that's just based on the amount of interest that we have on critical minerals and commodities in general.
Thank you very much, Andres. Really appreciate it. Andres Rincon, head of ETF sales and strategy at TD Securities. Coming up, we're going to talk to the CFO of Air Canada, and we'll touch on the company's better than expected revenue and what's ahead for service to Cuba. Stick with us. Let's talk now to the CFO of Air Canada, John Debert. Thank you very much indeed for joining us.
Morning, Andrew.
Really appreciate it. I'm just looking back at the history of the company over the past decade or so. I mean, we know that 2020, 2021, even 2022 were so tough. I mean, you bled almost $4 billion in free cash flow in 2020, almost $3 billion in 2021. You're back into positive cash flow. One thing I'm curious about, though, is the Atlantic is your biggest single source of revenue. Is that essentially flights to Europe?
Yeah, our transatlantic network is phenomenal. It continues to grow. But we also have very strong international presence in Asia, so Trans-Pacific is very strong as well. Don't forget, we operate out of 3 major hubs, so Montreal, Toronto, and Vancouver. We are an international airline by all accounts, equally strong in the Caribbean, southern destinations, continuing to open up Latin America. So a very well-diversified airline with clearly a lot of strength on the transatlantic network right now.
Yeah, it's interesting. According to Bloomberg, the Atlantic was 28% of your revenue last year. Canada was 24%. And then transborder to the States dropping below 18%. What about, is that category still under pressure with Canadians not vacationing in the U.S.?
We had clearly an adjustment in the spring of 2025. So that was the most impactful change. It was down about 12, 13% or so, has kind of stayed at that level now, really stabilized at kind of minus 10 to 15%, depending on the routes and so on. So I think, transborder stabilized. the real positive for Air Canada is we have so many options with our network, very agile ability to reposition aircraft. We've done that very well. We've opened up much more Latin America. The Caribbean continues to do well. So there's a great diversity. And I would say on top of that, corporate travelers still do travel through the U.S. quite a bit. And we also have a very strong Sixth Freedom traffic, which brings Americans through Canada to the world.
You got an upgrade in 2024 from S&P. You went up to BB from BB-. Now, you'll update me if you've been upgraded since then. But you're still sub-investment grade. Does that complicate life for you as a CFO? It presumably increases your borrowing cost.
Well, I'd say that overall, we have a pretty balanced capital allocation strategy. We keep a low debt. Right now, about 1.7 times our earnings, so our net debt leverage. Our borrowing capacity is very strong. We get very, I would say, almost investment grade like cost of capital, to be honest with you. Aircraft are also very liquid, very strong assets, and therefore produce fairly competitive debt pricing when you do finance them. Right. So overall, I think we have a balanced approach here. We want to, one, invest in the airline. Two is we want to make sure we keep a strong balance sheet. And three is make sure that we return capital and cash to investors. And we've been doing all three, I'd say, rather well, particularly since 2024 through 2025, and we'll continue to even do better in 26 and 27.
I know this is volatile and it's very dependent on capital spending, and you have been buying a lot of new aircraft. But according to Bloomberg data, your free cash flow dropped to about $750 million last year, and it was about $1.3 billion in 2024. Why was there that drop in free cash flow?
We're starting to ramp up our investment cycle. We're going to take on about 70 aircraft between here and the end of 2028. Last year was, I believe, 15 aircraft. We'll have another 35 aircraft delivered in 2026, and that'll continue through 27, 28. So we are going through an investment cycle. It will modernize our fleet. It'll also add so much more network capacity and optimization. In 2019, we were running at about 113 billion available seat miles, total capacity of our network. And in 2025, that'll be about 105 billion. So we haven't yet recovered back to our full 2019 levels, which leaves a lot of great opportunity for us to continue to grow. And that's where the investments are going. So at $750 million, still, 3.5% of revenues. Feel good about that. We deployed $1.3 billion to buybacks of $2 billion of total free cash flow generation in the last 24 months. We've managed our leverage to be, very competitive at 1.7 times, and we're investing in the fleet. So I feel very good about a balanced allocation of capital.
We're tight for time, and I'm sorry about this, but the Globe and Mail says that more than 90,000 air passenger complaints against all of the airlines are backed up in the system. Yes. It sounds like your industry is antagonizing a lot of customers.
It's a difficult process, and we acknowledge that there is some administrative burden and bureaucracy in there. I think it really needs solutions both with the regulator and the airlines together. We do our very best to process all these claims. These claims then sometimes do get re-administered at the CTA level. Technology needs to play a role, and I think smoothing out regulation so it's easier to apply and easier to interpret will also help. There's opportunities for everybody, and we would like to have less burden as well as anybody else. And clearly, we want our passengers to have a seamless experience when they deal with us. When we don't live up to their expectations, we do want to make sure that they're compensated properly. We do need to see some relief in the overall administration, and we want to be part of that.
Just remind, your job is complex, to say the least. You're dealing with a highly capital-intensive industry. Give us an idea, how many flights does Air Canada do each day right now? Can you give us a ballpark
I think
number?
It's about 1,300 flights in total every single day.
How many,
and
sorry?
We fly 1,300 flights a day. It's a logistical beast, and 45 million passengers a year. And so it gives you a pretty good idea. It's 1,300, and we have an extraordinary workforce that honestly is on top of every one of those flights. And it's food on the plane, bags on the plane, get you to the destination. And we do this with a lot of commitment and conviction.
45 million people a year. And what would you spend most of your time on? Would you say, you personally?
That's a great question. I think it's really helping the airline navigate growth. We're in a growth cycle. It's a very fine balance, as you've well indicated, between managing a strong balance sheet, returning capital to investors, and being able to bring and deploy capital to the airline effectively. Spend a lot of time making sure that we're delivering on our 2028 objectives. We put objectives out with our Investor Day in December of 24. We're fully committed to creating value, but also creating an exceptional airline for our customers. And doing all of that requires work from an incredible team, and the management team here is phenomenal.
Thank you very much. I really appreciate it.
Thank you so much, Andrew.
John DeBert, CFO of Air Canada. Okay, coming up, we are expecting to hear from the Prime Minister, and he's set to unveil the country's multi-billion-dollar defense industrial strategy. Canada's inflation rate slowed last month, even though the expiry of last year's federal tax break did increase prices a little bit. Data from StatsCan indicates that the annual rate of inflation ticked down to 2.3% versus December. Gasoline prices slowed, and shelter price inflation dropped below 2% for the first time in nearly 5 years. Canada has reached a preliminary trade understanding with Mexico. The Minister of U.S. Trade, Dominique LeBlanc, says this country and Mexico will work to expand port-to-port trade and will hold talks on security. Ottawa sees investment opportunities in pharmaceuticals and agriculture. A Canadian delegation is in Mexico until Friday. Shares in Sherritt plunging. That company is cutting back operations at its nickel cobalt joint venture in Cuba due to fuel shortages in that country. And let's have a look at the North American markets. You can see stocks are down today. We have seen weakness once again in a whole bunch of the giant U.S. tech stocks. Just looking at active shares in Toronto, big traders buy value right now. Enbridge stock down about $3. It got a downgrade at Jefferies after the massive run-up in those shares. Magna losing some altitude, down around 4%. And the energy stock, Cenovus is off. Well, Cenovus is off. CN Rail, though, is up. Canadian Natural Resources down about 2%. We are expecting to hear shortly from the Prime Minister, Mr. Carney. He's at Montreal at a CAE facility, and he's set to unveil Canada's industrial defense strategy. We plan to bring you that as soon as it happens. Meanwhile, a high-powered Canadian delegation landed in Mexico City for the largest trade mission to Mexico in decades. And the goal here is locking in stronger bilateral ties as U.S. President Donald Trump threatens to rip up the overall North American Free Trade Agreement. And that coincides with Ottawa naming a new chief trade negotiator. Here's CTV's Rachel Aiello with what's on the table in Mexico.
Hundreds of delegates representing businesses and key sectors across Canada are taking part in the biggest trade mission to Mexico in decades.
Here, we have the tremendous opportunity to start to work in this direction.
Led by Minister Dominique LeBlanc, Canadians are meeting with Mexican government officials, policy experts, and industry leaders to forge new alliances.
It's a long time coming. This is an opportunity to go well beyond where we have been.
But the mission is also an opportunity to strategize ahead of this year's mandatory review of the Canada-United States-Mexico Agreement. Given President Donald Trump's threats to tear up the Trilateral Trade Pact, a deal that has shielded most Canadian and Mexican commerce from tariffs, Team Canada is looking at bilateral relations with Mexico in new light.
We haven't actually leaned in to what CUSMA, our trade agreement, affords us, and we just have not invested in building the relationships or educating ourselves or connecting those businesses.
Merchandise trade between Canada and Mexico has increased 12-fold since the original NAFTA came into force. But business leaders see potential to gain more market access.
We have some really cool meetings set up.
It's important for us to be here on the ground and see if there's potential for our producers to expand their export to Mexico.
With that joint CUSMA review coming in July, the Prime Minister announced today longtime senior public servant Janice Charette will become Canada's next chief trade negotiator to the United States. Charette will work alongside Mark Wiseman, Canada's ambassador to the U.S., who just started in D.C. this week.
Of course, she's an incredibly experienced and seasoned bureaucrat and diplomat. This is exactly what we need.
Reacting to Charette's appointment, the Conservatives disagreed, saying what Canadian workers need is a deal and not another negotiator.
Let's head over to Montreal now. The Prime Minister, Mark Carney, about to unveil Canada's defence industrial strategy, and he's being introduced by the Industry Minister, Mélanie Joly.
Qui est quand même une stratégie nouvelle parce que c'est la première stratégie industrielle de la défense de l'histoire moderne du Canada. J'aimerais également, en particulier, remercier mes collègues, le ministre de la Défense, David McGuinty, et également le secrétaire d'État à l'approvisionnement militaire, Stephen Fuhr, pour tout leur travail dans le développement de cette stratégie. That was for you what I did. Nous le savons, nous vivons présentement dans un monde beaucoup plus chaotique et plus dangereux. Nous sommes également en pleine tension tarifaire. And many workers are also affected by tariffs. So to all of you, to all the workers watching us right now, we had you in mind when building this strategy. So this is for you, for all those who want to be part in something that is greater than themselves, to build the best to equip our Canadian Armed Forces and to build Canada strong. So, without further ado, ça me fait plaisir de vous présenter celui qui a vraiment donné le leadership à cette stratégie industrielle de la défense, le Premier ministre du Canada, Mark Carney.
Merci. Merci beaucoup. Merci, Madame la mairesse, d'être venue. Merci, Mélanie, Madame la ministre de l'Industrie. Merci tout le monde ici à ce fleuron canadien, ce fleuron québécois. C'est un grand plaisir d'être ici, de retour à Montréal, d'être chez CAE, un chef de file canadien en défense qui fabrique ce dont le Canada et le monde a besoin. Ouais. Et il faut le dire, depuis des générations, les travailleurs qualifiés du Québec soutiennent les industries qui assurent la sécurité et la prospérité du Canada. Les Québécois et Québécoises savent ce que signifie construire les choses qui comptent. Le travail que vous faites ici soutient nos familles. Il renforce nos communautés. Il défend notre nation. Et nous sommes ici aujourd'hui pour renforcer cette tradition. Canada's new government was elected with a clear mandate to make Canada stronger, more resilient, and more independent. We're pursuing that on every front, building affordable housing at rates not seen in generations, creating one Canadian economy, realizing Canada's full potential as an energy superpower, and striking new international agreements with reliable partners. None of these goals will come easily. All will require ambition, collaboration, and, on occasion, sacrifice. But Canadians are up for it. We know, as Melanie just said, we know that the world has changed and that Canada must change with it. Les présomptions qui ont défini des décennies de politique canadienne en matière de défense et d'affaires étrangères ont été chamboulées. Les menaces auxquelles nous faisons face sont nombreuses et se multiplient. Des incursions dans notre Arctique aux attaques visant notre cyberespace. La nature de la guerre elle-même est en rapide changement, poussée par la prolifération des drones, de systèmes autonomes et d'armes en orbite. Les théâtres de potentiels conflits se sont rapprochés de nos frontières. Dans un monde plus divisé et dangereux, le leadership canadien se définira non seulement par la force de nos valeurs, mais aussi par la valeur de notre force. Et cette force doit être ciblée, renforcée et surtout canadienne. C'est pourquoi, immédiatement après les élections, le nouveau gouvernement du Canada s'est lancé dans une mission ambitieuse visant à reconstruire nos forces armées, à les réarmer et à y réinvestir. We're now on track to meet our 2% NATO target by this spring, a full decade ahead of the previous schedule. Recruitment to the Canadian Armed Forces is up by 13% since June. We've signed a series of new defense and security partnerships with allies who share our interests, who share our values and our history. And that includes the landmark SAFE agreement with the EU that the Minister of National Defense, still have your pen, that he signed with the European Union last week. Crucially, we have committed to double our defense expenditures by the end of this decade. And that amounts to an additional $80 billion over the next 5 years. In addition, as part of our NATO commitments, we will invest an additional $45 billion per year on domestic resilience, yielding both security and economic benefits. In total, over the next decade, Canada will invest $180 billion directly in defense procurement, $290 billion in defense and security-related infrastructure, and create over $125 billion in additional downstream economic benefits. L'ampleur de ces engagements témoigne de la gravité des nouvelles menaces auxquelles nous sommes confrontés. Il crée également d'énormes possibilités économiques. L'industrie canadienne de la défense emploie déjà plus de 80 000 Canadiens directement et beaucoup plus indirectement. Et il est impératif de maximiser le rendement de ces investissements de plus de 500 milliards de dollars pour renforcer notre sécurité, accroître nos emplois et notre prospérité et protéger notre souveraineté. Defending Canada means more than just increasing the size of our military. It also means the strength of our industries, the resilience of our economy, and our capacity to act independently when it matters the most. Our national security and our economic security go hand in hand. To those ends, as the Minister mentioned, we are announcing Canada's first ever defense industrial strategy. It's a bold plan to get our armed forces what they need when they need it. It's a bold plan to scale Canadian defense companies and to put hundreds of billions of dollars into strategic sectors of our economy while creating over 125,000 high-paying jobs across Canada. Its framework is simple: build, partner, buy. First, we will build in Canada and prioritize Canadian companies. As a matter of policy, military procurement in areas where we have sovereign capabilities will be directed to Canadian firms first. Where we can't build alone, we will partner with like-minded allies, helping to attract investment, transfer intellectual property, and integrate supply chains so that public dollars flow back to Canada and Canadian jobs created right here. And only after exhausting those first two options will we buy from abroad. Even then, we will ensure the maximum benefits are returned to Canada throughout the value chain, including through a modernized industrial and technological benefits regime. The centerpiece of our new approach is the Defense Investment Agency, or DIA. The DIA will streamline and speed procurement. It'll cut red tape, and it'll expand domestic production. It has three fundamental objectives. First, to protect Canada's sovereignty, particularly in the Arctic, by ensuring our women and men in uniform have the tools they need to defend our country. Secondly, the DIA will work to build Canadian prosperity. And thirdly, we'll work to strengthen Canada's strategic autonomy, which means our ability to act independently in a more dangerous world. We start by defending Canadians. And the truth is, over the last few decades, Canada has neither spent enough on our defense nor invested enough in our defense industries. We've relied too heavily on our geography and others to protect us. And this has created vulnerabilities that we can no longer afford and dependencies that we can no longer sustain. Alors, les processus d'approvisionnement du gouvernement sont trop longs, trop fragmentés et trop réactifs. Pour de nombreuses entreprises canadiennes, il est plus facile de vendre à des gouvernements étrangers qu'aux nôtres. Le processus actuel renforce notre dépendance aux fournisseurs étrangers et affaiblit les entreprises que nous devrions plutôt rendre plus fortes. Nous avons pris de nouveaux engagements importants en matière de défense. Nous devons faire du même en ce qui concerne nos dépenses. Our Canadian Armed Forces will be backed by a resilient Canadian defense industrial base. Every dollar will be spent to maximize jobs, careers, and industries right here in Canada. As I mentioned earlier, we'll start by concentrating on those sovereign capabilities that are critical to our ability to defend our country. These are areas where we're already strong or where we have the potential to lead. The obvious example, we're in the middle of it. Quebec and Canada have proven strengths in aircraft engines, parts, simulation. With CAE, we are the world leader in training and simulation. You are the world leaders in training and simulation. Bravo. Bravo à vous. Across Canada, we have other strengths. We produce world-class combat vehicles, munitions, and naval vessels. Et par ailleurs, le Canada développe son leadership dans des domaines qui deviendront de plus en plus essentiels à la défense, notamment l'espace, l'intelligence artificielle, la cybersécurité, la technologie quantique, les contre-mesures médicales, la robotique et les drones. Le renforcement de nos capacités souveraines et les emplois de qualité qui en découlent nécessitera divers utiles, dont notre volonté d'acheter canadien dans la mesure du possible. Our strategy rests on 5 pillars. First, renewing our relationship with industry by providing clear long-term demand signals. Secondly, procuring strategically with greater efficiency through that build, partner, buy strategy. Third, investing in innovation and workforce development. Fourth, securing supply chains. And finally, working with domestic partners, including in Canada's north. The details of these strategies are outlined in the strategy document we're releasing today, but I want to touch on one aspect that matters particularly for our long-term competitiveness and is directly relevant to the activities of CAE. This company knows that our defense sector is research intensive. It's 3 times more R&D intensive than Canadian manufacturing overall. And history shows that defense spending catalyzes innovation far beyond the sector itself. Globally, there's examples: computing, GPS, powerful cameras in our phones, all emerge from defense investment. We are going to boost government investment in defense-related research and development by 85% to help develop the next generation of capabilities in AI, in quantum, in robotics, and autonomous systems. I think we can see examples of that all around us. In part to do that, we're creating a new Bureau of Research, Engineering, and Advanced Leadership, Borealis, to coordinate and accelerate defense research and innovation in frontier technologies like quantum and AI. En somme, nos principaux objectifs consiste à augmenter les revenus du secteur canadien de la défense de plus de 220%, nos exportations dans ce domaine de 50% et à créer 125 000 nouveaux emplois directement liés au secteur de la défense.
125,000 new jobs linked to it.
Et pour les PME, la stratégie vise une augmentation annuelle des revenus tirés de la défense de 2,8 milliards de dollars pour atteindre 4,5 milliards. Ces avantages directs auront des répercussions positives sur l'ensemble de notre économie. Chaque emploi créé signifie un Canadien ou un Canadien de plus qui bénéficiera d'une plus grande sécurité. Une famille qui se sentira moins inquiète pour l'avenir. Une économie locale qui pourra subvenir à ses besoins et offrir des possibilités à la prochaine génération.
Opportunities for the next generation.
Prime Minister there providing details of what the government bills as the first defence industrial strategy. But of course, for decades, Canada has tried to boost domestic industry when buying weapons. They are providing, though, some numbers here. There's going to be this new $4 billion defence platform at the Business Development Bank of Canada to provide financing for companies. And then there's going to be an initial amount of almost $660 million under the Strategic Response Fund, Innovative Solutions Canada, and Life Sciences. And they're going to be commercializing defense and so-called dual-use technologies. And then the really big money, though, is going to come in forthcoming budgets. They are talking about tens of billions of dollars to boost defense spending in this country. Of course, we have to be careful. Some of the stuff that will be earmarked as defense will, in fact, be building roads and power and stuff like that. But industrial infrastructure is, of course, a huge part of that. It's interesting as well. They're going to set up a drone center of excellence based on the National Research Council. And the Ukrainians have built a formidable drone weapons industry. No reason why Canada couldn't do the same. They say that defense investments will be 2% of GDP in 2025-26, rising to 5% of GDP by 2035. That would be a massive increase. And they're going to outline in budget 2025, well, they outlined some of this. They outlined $81.8 billion to reinvest in the Canadian forces. That came out in budget 2025. And of course, I didn't hear the Prime Minister mention the United States, but the implication here is cutting this country's reliance on U.S. armaments. Thanks very much for watching The Open. Morning markets are up next.